Imagine the silence of a computer screen just moments before a finger presses the key to move $18,250,000,000. This is not just a high number on a corporate ledger, it is the single largest financial transaction in the history of Home Depot. This massive wire transfer was not made to build hundreds of new stores or to pay out a massive special dividend to its shareholders. Instead, it was a high-stakes bet placed by the Chief Executive Officer, Ted Decker, on the very soul of the American construction industry. The latest earnings call provided the first real test of this massive strategic pivot, and the numbers reveal a company that is fundamentally transforming itself in real time. We are currently witnessing the end of an era for the traditional hardware store and the birth of a new kind of construction empire. To understand what is happening inside the headquarters in Atlanta, we have to look at the 5 key elements of this story. The what is the massive integration of SRS Distribution into the Home Depot ecosystem. The who is a trio of conflicting forces, including Ted Decker, the strategic architect of this pivot, the pro-contractor who is becoming the most important customer for the company, and the Federal Reserve, which acts as the primary antagonist by keeping interest rates high and the housing market frozen. The when is right now, during a fiscal cycle where every penny of consumer spending is being scrutinized by Wall Street analysts. The where is across thousands of retail locations and newly acquired industrial hubs of the SRS Distribution network. And finally, the why is the most critical part of the puzzle. Home Depot is fighting for its long-term survival in a world where the average homeowner can no longer afford to renovate their kitchen or build a new deck. The headlines following the recent earnings report were surprisingly optimistic for most people. Major news outlets focused on a modest beat in earnings per share, which sparked a temporary rally in the stock price. For the casual observer, it looked like business as usual for the largest home improvement retailer in the world. However, the reality beneath those surface numbers is far more sober. While the total revenue appeared stable, it was propped up by the new acquisition rather than organic growth inside the physical stores. The traditional retail foot traffic, which represents the millions of people who visit Home Depot every weekend to buy a new drill or a gallon of paint, is in a steady and concerning decline. This is the gap between the headline and the reality. The company is successfully pivoting its business model, but it is doing so because the foundation of its old model is showing deep cracks. Retail foot traffic is being replaced by heavy logistics, and the simple cash transactions of the past are being replaced by complex professional debt. This brings us to the strategic context of what many on Wall Street are calling the $18 billion gamble. One must ask why Home Depot would choose this specific moment, when interest rates are at a 20-year high, to buy a company like SRS Distribution that specializes in roofing, landscaping, and pool supplies. The answer lies in the dark flow of the current economy. If you look at the internal data, the divergence is clear. Sales to do-it-yourself, consumers are shrinking because people are staying in their homes longer and spending less on non-essential projects. However, the professional market remains relatively stable. These are the contractors who are hired for essential repairs like a failing roof or a broken industrial water main. By spending $18 billion to acquire SRS Distribution, Ted Decker is trying to capture that essential professional market and create a moat that even a giant like Amazon cannot touch. You can buy a screwdriver on the internet, but you cannot easily coordinate a flatbed delivery of 60 bundles of shingles to a job site in the middle of a workday. Home Depot is moving away from being a hardware store and toward being a structural partner for every major construction job in the country. Before we continue, subscribe to the channel and tell us in the comments where you are watching from. This moment in time represents a total reimagining of what Home Depot actually is. For decades, it was a place of inspiration for the American dream of home ownership and weekend improvement. Today, it is becoming a massive logistics engine and a silent partner in the industrial construction chain that keeps the infrastructure of the country moving even when the housing market is stuck in place. The pressure from the Federal Reserve has forced this evolution, turning a retail giant into a specialized industrial powerhouse. It is a transition that requires more warehouse space, more specialized delivery trucks, and a much higher level of credit risk. When a contractor buys $50,000 worth of roofing materials, they often do not pay with a credit card at the register. They operate on lines of credit, and Home Depot is now the one holding that professional debt. Wall Street saw the revenue beat, but they missed the shrinking gross margin that explains exactly where that money is actually going. And that is where the story takes a dark turn. To understand why this financial turn is so significant, one must look directly into the cold heart of the comparable store sales figures. During the most recent fiscal quarter, Home Depot reported a decline in these sales that would typically send a retail stock into a free fall. Specifically, transactions that the company labels as big-ticket projects, which are any purchase over $1,000, have seen a persistent and sharp drop. This is the clearest sign that the average homeowner has reached a breaking point. They are no longer walking into the orange box to buy a premium kitchen suite or the materials for an extensive outdoor renovation. Instead, they are hunkering down. They are fixing only what is broken and ignoring what is merely outdated. This stabilization of the do-it-yourself market is not just a temporary dip. It is a fundamental cooling of the consumer enthusiasm that fueled the massive growth of the early 2020s. This is where the absorption of SRS Distribution becomes the most critical part of the balance sheet. Integrating a multi-billion-dollar entity into a legacy retail operation is not as simple as changing the logo on the trucks. It is an expensive and labor-intensive process that eats into the short-term profitability of the company. When you look at the margins, you see the true cost of becoming a construction empire. Selling a hammer to a homeowner at a retail price yields a high profit margin. However, delivering 2 tons of roofing tile to a professional job site at a contracted bulk rate is a completely different financial animal. The margins are thinner, and the operational costs are higher, because you need specialized cranes, flatbed trucks, and a workforce that understands industrial logistics. Ted Decker is essentially trading the high profit margins of the past for the high volume stability of the future. It is a necessary sacrifice, but it is one that makes Wall Street investors incredibly nervous. These investors are looking at the debt-to-equity ratios and wondering if the company has overextended itself. $18 billion of new debt in an environment where the Federal Reserve keeps interest rates elevated is a heavy burden to carry. While the management team remains soberly confident, there is an underlying tension in every conversation about the company's future. If the housing turnover does not recover by 2025 or 2026, this massive bet on professional contractors could transform from an engine of growth into a financial anchor that drags down the entire organization. The risk is that the company is building a massive supply chain for a construction industry that might remain stagnant for longer than anyone anticipated. There is one metric that the general media often overlooks, but it is the one that keeps the executive team in Atlanta awake at night. That is the backlog of professional projects. While individual consumers are pulling back, professional contractors report that they still have months of work lined up. This backlog is the only thing standing between a soft landing and a total construction freeze. Home Depot is effectively betting that this backlog will last long enough for the Federal Reserve to eventually blink and lower interest rates. Lower rates would then unlock the millions of homes currently stuck in the frozen housing market, allowing homeowners to finally sell and buy new properties, which usually triggers a massive wave of renovation spending. But here is the real problem. Home Depot is no longer just fighting for market share against its traditional retail rivals. They are locked in a structural battle against the Federal Reserve's interest rate timeline. Every month that rates stay high, the pressure on the $18 billion acquisition increases. The company is shifting from being a retail store to an ecosystem, a word that Ted Decker uses frequently to describe the seamless integration of supply chains, credit lines, and delivery logistics. By buying its way into the complex professional market, Home Depot is building a moat that Amazon cannot touch. You cannot ship a swimming pool pump and 40 bags of concrete through a standard parcel delivery service efficiently. This is industrial-scale commerce, and it is the only territory left where Home Depot can claim absolute dominance. Imagine the floor of a standard Home Depot store on a Tuesday afternoon. It is quieter than it used to be. The rhythmic sound of the orange forklifts is still there, but the baskets are less full. Now, compare that to an SRS Distribution hub. There, the activity is frantic. Phone lines are buzzing with orders for complex roofing systems and commercial landscaping projects. This is the new reality of the company. It is a tale of 2 businesses living under one roof. One side is the aging retail giant that everyone knows, and the other is the hidden industrial backbone that the company is desperately trying to build. This transition is not just about sales figures. It is about a total cultural shift within the organization, from being a store for the people to being a partner for the industry. The investors watch the margin compression with eagle eyes. They see the gross margin shrinking from the traditional 34% down towards something more characteristic of a distributor rather than a retailer. For a company that has been a darling of the stock market for decades, this shift is jarring. It requires a different kind of patience. Ted Decker is asking the world to look past the next 4 quarters and see the next 20 years. He is arguing that by the time the housing market unfreezes, Home Depot will not just be a store where you go to buy parts. It will be the central nervous system of the entire American renovation industry. The numbers from the latest report validate this massive transformation, but they also reveal a massive vulnerability in the housing market that nobody is talking about. The very contractors that Home Depot is now relying on are themselves dependent on a housing market that is currently being held hostage by macroeconomic forces far beyond their control. The bridge is being built as the company crosses it, and the stakes could not be higher. If the strategy succeeds, Home Depot will own the professional landscape for a generation. If it fails, they will have spent $18 billion to buy a front-row seat to a construction slowdown that they cannot stop. Everything now depends on how the market reacts to the next move from the central bank. This investment represents a fundamental inversion of how the market perceives the company. The bull case for Home Depot suggests that it has successfully transitioned from a discretionary retailer into the essential infrastructure of American renovation. Proponents of this view argue that the housing stock in the United States is aging at an unprecedented rate, with the median age of a home now exceeding 40 years. This reality creates a floor for demand that is largely independent of mortgage rates. Even if a homeowner is locked into a low interest rate and refuses to sell their property, they still face the reality of a roof that leaks, a water heater that fails, or a kitchen that has simply reached the end of its functional life. By acquiring SRS Distribution, Ted Decker has positioned the company to be the primary beneficiary of this non-discretionary maintenance. The bull narrative paints a picture of a company that is no longer a victim of the business cycle, but is instead a permanent partner in the structural preservation of the wealth of the nation. However, the bear case is equally compelling and revolves around the sheer weight of the debt used to fund this expansion. Critics point out that Home Depot is becoming over-leveraged at the exact moment when the property market is most stagnant. If interest rates remain elevated for several more years, the cost of servicing the debt from the $18.25 billion acquisition could erode the profits that the company worked so hard to secure. The bear perspective suggests that Home Depot may have mistimed the market, buying a massive distribution engine just as the construction industry is entering a long period of hibernation. In this view, the company is not building a moat, but rather an expensive bridge to a future that may not arrive as quickly as they hoped. For investors, this marks a profound shift from a growth play to a structural transformation play. In the past, you bought Home Depot stock because you believed in the resilience of the American consumer and the joy of home improvement. Now, you buy it because you believe in the industrialization of the renovation supply chain. The quarterly earnings call has changed from a discussion about lawn mowers and paint sales into a complex debate about logistical efficiency and trade credit. This consolidation of the construction supply chain is a signal that the era of the small independent hardware distributor is coming to an end. Home Depot is using its massive scale to vacuum up the fragmented professional market, creating a centralized power that can dictate prices and terms in a way that was previously impossible. Over the next 12 months, the most critical factor to watch will be the capture rate of SRS Distribution customers into the legacy Home Depot ecosystem. Success will be measured by whether a roofing contractor who previously only bought shingles from SRS Distribution now starts buying their lumber, power tools, and fasteners from Home Depot. If Ted Decker can prove that these two distinct customer bases can be merged into a single loyal professional segment, the $18 billion gamble will be seen as a masterstroke of corporate strategy. However, this move also puts the company on an inevitable collision course with industrial distributors that they once considered allies or distant neighbors. They are no longer just competing with Lowe's. They are now fighting for territory against specialized giants like Ferguson or ABC Supply. This is a much tougher neighborhood, and the margins for error are razor thin. As we look toward 2025 and 2026, the success of this pivot will serve as a bellwether for the entire American economy. If Home Depot can thrive despite a frozen housing market, it will prove that the demand for skilled labor and professional building materials is the new bedrock of the economy. If they struggle, it will be a warning sign that the high interest rate environment created by the Federal Reserve has finally started to crack even the strongest pillars of the industry. The company is betting that the American drive to build and improve is more powerful than any macroeconomic headwind. It is a bold, high-stakes wager that assumes the future of the company lies not in the hands of the weekend warrior, but in the hands of the professional who carries the tools for a living. If you want to understand what these massive earnings reports actually mean for the long-term structure of our economy, and not just the temporary fluctuations of a stock price, you should subscribe to this channel. We go beyond the headlines to analyze the underlying shifts that are reshaping the world we live in. Understanding the move from retail to industrial distribution is essential for anyone trying to navigate the current financial landscape. In a quiet moment of reflection, one might look at the familiar orange box on the corner of the street and realize it is no longer just a store. It has become a silent partner in almost every street and every neighborhood in the country. It is the hidden force behind the new roof on your neighbor's house and the plumbing repair in the building downtown. Home Depot did not spend $18.25 billion to simply be a better hardware store. It spent that money to become a different kind of company entirely. It has moved from the edge of our lives into the very core of our infrastructure. The final question is not whether the company can afford to make this bet. The real question is whether the American dream of building can still afford the price of admission in a world where everything is being consolidated into a single massive ecosystem. The orange sign still glows, but the business behind it has changed forever.